When clients would like to construct well-balanced portfolios, ETFs are definitely a good help to do so. ETFs are very liquid instruments, very easy to understand instruments, as well as they are broadly diversified instruments. And hence, as we know, a broad portfolio should be diversified across a lot of asset classes, a lot of regions, and also a lot of stocks. When clients consider to buy an ETF, they should consider three main topics with ETFs. First topic is the tracking difference of an ETF versus its benchmark, so-called the index. In other words, how well the ETF tracks the index, how big is the difference in performance between the ETF and the index. Secondly, as the ETF is traded and bought and sold via an exchange, let's say the LSE or the Euronext or the etc. in Germany, they should check how much such a trade will cost them. Hence, how far the bid and the ask, so the buy and the sell price, is away from each other. That gives them an indication how expensive it is to trade the ETF. Thirdly, the client should consider or understand how the ETF is actually constructed. In other words, is it using a swap to replicate the index, so a derivative, or is it investing in physical stock like a cash-based ETF does? My preference would be for easy accessible markets like the FTSE 100, the FTSE 250 or the S&P 500, I would prefer cash-based ETFs. I'm often asked whether the use of smart beta in a portfolio is a good thing to do or is meaningful to do. And when we talk about smart beta, I think we need some clarification around the word smart beta. We prefer the word alternative beta because it is beta, market systematic risk, but it is alternatively weighted. That means it's not according to market capitalization as the normal indices are, like FTSE 100 or S&P 500. Alternative beta is actually a way to get access to those markets in a very specific way using factors, which in other words is a premium you can harvest by being exposed to a certain type of stocks or bonds. And in this respect, yes, if you have a broad diversified portfolio, adding some specific factors like value or growth or low volatility or quality stocks, that makes definitely sense. But it needs to be put into context of the overall portfolio. Social responsible investing, or SRI, or in other words also ESG, economically, socially and governmental based investing, is a fairly new theme amongst European investors. It has attracted quite some new ETF flows over the course of the last 3 to 4 years, and has become the new way of getting exposure and access to markets in a way that they can be aligned with their own values of investors. Secondly, SRI portfolios, especially SRI passive portfolios, has shown that they have the similar or same level of return, but with way less risk, which is exactly what investors would like to see for their investments.